European stocks hit multiple highs this week, so are investors feeling optimistic? The Stoxx 600 has hit multiple new highs this week off the back of an earnings season that's largely been stronger than forecast, and the Eurozone's GDP beat forecasts for the third quarter at 1.3% year-on-year. So are markets ready to buy back into Europe? Benedicte Lowe is equity derivatives strategist for Europe at BNP Paribas 360. Benedicte, we've seen a lot of worries in recent months about economic weakness in the Eurozone, especially in Germany. Is the economy bouncing back?
Yes, I would say the data is turning around the corner. We're seeing better data when you look at PMIs, but also a confidence indicator. And this is the roadmap that we had for this year. Our economists expected better soft data for 2025, and those to materialize into better hard data for more the 2026 story. So you're right there where we're seeing PMIs, confidence indicator on the rise, and we expect more of that momentum to feed into the data.
Is Germany's fiscal stimulus starting to make its way into the real economy? How much difference do you think that's going to make?
So definitely our bullish growth story for Europe has been predicated a lot on the German fiscal stimulus, and we're seeing some good signs of that. Confidence indicator, as I've mentioned, but also activity starting to pick up in Germany. Germany is leading the way, and we expect more actually of that better growth in the data, and this is reinforcing our bullish growth story for Europe, but also helping our equity view of higher upside for stocks into year-end and for next year.
What did you make then of this European earnings season? We saw generally some better numbers than were forecast, didn't we?
Yes, definitely. So I would say the earnings season, both in the US and Europe, have been good. It's been still better in the US than in Europe, but as a whole, we're seeing some green shoot in Europe, which we hadn't seen at all at the previous earnings season. And one very interesting indicator is the fact that when you look at the ratio of beats versus missed and how they've been complemented or punished by the market, you see the market reaction was actually skewed quite positively. And that tells us two things. It tells us, first of all, that expectations were quite low going into it, so there was positive surprise, but also that momentum is picking up on the growth story in Europe as a whole. So some positive sign for the earnings season with our bullish growth for next year, some expectation of even better earnings for the quarters ahead.
We're obviously seeing volatility again today in the market. That started in US stocks. It's partly about concern the Federal Reserve might not cut rates in December at all, and partly about very high valuations in AI companies. But what could the consequences be for European stocks of a further sell-off in some of those really highly valued stocks in the US?
Yeah, so we've seen this dynamic of spot up, vol up that has been really strong in the US, more specifically. And we've seen this repercussion also in Europe with vol that has been actually quite big. Now, there's less of a risk in Europe along that story because the market is less concentrated than it is in the US. When you look at the big tech names, they make up a huge portion of the performance of the S&P this year. The performance is different in Europe. It's been more driven by banks, by defense. So there's less of that starting point. It's a bit less of a worry, I would say, in Europe than it is in the US. Now, obviously, if there was to be, which is not our base case, but if there was to be a tech sell-off in the US, that would have also implications throughout the market in Europe. But our starting point is a healthier market in Europe, I would say, than in the US.
Could those worries carry through into European tech companies, semiconductors, for example? Should investors be cautious on those stocks?
There is a risk in a sense that if there's a crash in the market, in the tech in the US, those will have some negative feedback loops for European markets. But this is not our base case, and this is not our thoughts into year end. We're actually still on the positive side for tech earnings, for tech in the US. We think it's interesting to look at some upside structure following the better entry point that we've had over the past 10 days or so in the US. And so we remain constructive overall on tech, and we think the European story is still still strong upside over the coming months.
With valuations this high overall, though, what should investors be watching out for?
So I think, as we've talked about, anything around the tech sector would be important, but also around the Fed. As you mentioned, valuations are very high, especially in the US. So there's a lot of expectation that the Fed will cut rates, which is also our expectation. We expect a 25 BP rate cuts at the December meeting, which the market is only pricing by half a chance at the moment. So I think there's more upside coming from that story. But I think that is very important because we've got high valuation. If the Fed is coming in with a dovish tone, I think this cycle has more to run.
That was Benedicte Lowe of BNP Paribas 360. Don't forget, you can watch more videos on Reuters.com.